So we ended another options expiration for the month of October. So we're going to take a look at some of the positions that we did. Most of these positions were recommended by our Trade Alerts, which is a service that we provide on our website, which is right here at tplinvestment.com. And if you get a chance, take a look at it. To gain access to the Trade Alerts, you have to sign up as a member. So there's also some free stuff, free weekly analysis and educational videos on here as well. So for the month of October, we mainly did SPY, only because in this type of volatile market, it's better to stick to the more liquid, easier trading stocks such as your ETFs. Now, the positions we recommended were mainly bear call spreads and bull put spreads. So when you combine them together, they form iron condors. Now, I know some of you might be looking at this and this looks rather confusing. It is confusing to me too sometimes. So I'm going to try to explain a little bit about the positions we did. So we did several, roughly 3 bear call spreads at each of these strike levels, and then we did the same amount of bull put spreads at these levels as well. Now with these positions, we didn't enter all of them at the same time, right? We entered some bear call spreads when the market was around here. I think we entered the 123 bear call spread roughly here. After this huge decline, we decided to, because we expected some kind of pullback, rather than playing calls on the rally, we did some bull put spreads only because of the amount of premium is so high. So when the market dropped here, we did some bull put spreads. When the market rallied towards this 20-day towards the resistance, we also entered some more bear call spreads. So in essence, we more or less captured the pivot points of the market. So, I mean, that's one way how I recommend doing condors, or at least iron condors. Rather than entering both at the same time, you want to enter when, let's say, bear call spreads are here. When the market drops to extreme level, bull put spreads. When it comes back, bear call spreads. When it drops to another extreme level, bull put spreads, right? I mean, if you enter both at the same time, I mean, when one of the direction drops, I mean, sure, you have a winning leg, but the losing leg is going to lose a lot more than your winning leg. And I know some of you know how to adjust your iron condors, but you have to think about the amount of commission you would use each time you adjust your condors. Okay, so let's take a look at how we did for this month. So pretty good, right? I mean, even though for a very volatile and rough month for the month of this October, we were still able to make a pretty good amount of money with our trade alerts, right? So here's the thing, in a bull market, anybody can make money. You can just basically close your eyes and buy any stocks that's going up, right? It's just a matter of how much. But in a bear market, this is where it really tests you as a trader to see how good you are playing such a volatile and rough market. And I find it much better to be trading options in this type of market because there's creative ways to offset some of the volatility and the wild swings, which is done through credit spreads or iron condors, whatever it might be, which is much more beneficial than trading straight directional. And once again, here's our website at tplinvestment.com for you guys to check out and sign up for the trade alerts.